at some of the important indicators moving forward as to what we think 2023 might look like. Starting things off, I wanted to ask you all a question, and we don't have a huge live audience, so a lot of folks, if you are watching this after the fact in the recording, think about this yourself. The question is, what was the most important world event during the course of your lifetime? If you're here, just type it in the chat. What are your thoughts? Come on, somebody's got this. Dave can unmute himself. Yeah, okay, cool. Dave, 9/11. Steve, what about you? Any thoughts?
Probably 9/11.
9/11. If
Yeah,
we have a large group of people here, then the point to this is going to be that many times, there would be different answers. 9/11 comes up often. 2008 recession can come up sometimes, and some other huge events that all of us kind of know come to mind. But the common theme between these events is we did not see them coming. And so the point here is, and I'll take this quote from the Stanford professor of political science, Scott Sagan, which is things that have never happened before happen all the time. So we will go ahead and start this economic panel off with that background understanding that, at the end of the day, the point is that none of us in the world have a crystal ball to be able to predict exactly what the future will look like. But the broader point here is that that does not end up leaving us in a situation where we cannot make any predictions and at least be able to get a gauge of what might happen in the future. This quote, I think, also aligns nicely from Mark Twain, although I've never actually been able to definitively prove that he said it. But history doesn't repeat itself, but it often rhymes. So just wanted to state that little bit of a paradox here. There's another quote from the great psychologist Carl Jung who said, paradox is the essence of life. And it is a bit of a paradox. Like, we know that we will have events that we will not be able to predict that hit us and change the way the world works in certain ways. And yet we also know that we can look at history and say, it's not going to be exactly the same, but we can use some of the lessons, principles, and basic economic indicators to be able to tell on a more general level what we think might happen. One more quick point that I wanted to make here: how many of the top companies, meaning most valuable companies in terms of market cap from the year 2000, were still on the list of top market cap companies in 2021? And without even making you all answer this question, I'll go ahead and tell you that it's only one of them. So only a 21-year period. And we would think that these companies that have so much money, they would be able to buy out the market to stay at the top where they are. And yet things do change. And within that, we can also tell a little bit of information that will help us planning moving forward. So I'm going to switch over and show you one quick piece of information that I find valuable to really visualize some of what we're talking about right now. And then I'm going to let the panelists jump into it with introducing Eddie after that. So what I wanted to show you here is, I think, illustrative of what we've just been talking about. But this is looking at historically every 10-year period in the stock market throughout the history of the stock market. And so we could play around with these numbers. I just have this set up as an initial contribution of $5,000 into the stock market, an annual contribution of $3,000 more dollars, and I've set that to go for 10 years. What we get down here is essentially every single 10-year period through the history of the stock market. The yellow line is your contributions during that period. So we would have contributed $35,000, and all of these different black scenarios are literally different time periods within the stock market. So if we had happened to put that initial contribution in 1893, then we would have ended up with $55,800 in our portfolio. Notice that there are a few scenarios, like between 1911 and 1920, where we would have actually ended up with a lower value portfolio. And so the point here is just to say that there's a number of plausibilities that could happen, but we can use this type of data analysis. So you notice down here that it says in 10% of the sequences, your final portfolio value ended up being less than the amount of your contributions.
Hey, Marshall.
Hey.
I can't see what you're looking at.
Oh.
I'm still looking at the 10 most valuable companies 2021.
Oh, you know what? Sorry. I totally didn't, I think I hit the, thank you for telling me that. Let me boop back out of here. Oh, you know what I did? I didn't share my whole screen. I only shared one tab. Thank you for telling me that. So this is what is, oh man, I'm so glad you piped up. I was assuming that you all could see this. Basically what this is this is just a little calculator. I'll send this link out in the follow-up, but this is what I've been talking about is we can run some scenarios where we do an initial contribution, here's the annual contribution, and then here's the 10 years. So on this yellow bar is your contributions to this theoretical fund. And all of these black lines are all of the plausible 10-year returns that if you had entered that initial contribution in the year 2006, then the period between 2006 to 2015, this is what your return would have been. And then this is what I was talking about down here. You can see that there are some scenarios like between 1999 and 2008, where your return, your portfolio value would have been lower. But we can use this data to see down here that that's only 10% of the sequences in which your final portfolio value ended up being less than the amount of your contributions. So the point there is just to say that really at the end of the day, what we're talking about when we're looking at some of these economic principles are, we don't know what the future holds, but we can use some of the indicators that we have available to us in order to predict what might happen moving forward and really use this as a risk analysis tool for us. So with that said, let's go ahead and jump into some of our questions. I am going to introduce our first panelist, which is Edia Sarapova. She is with Denver Wealth Management. She is actually a trained CPA, although she has done financial advising for her entire career. So Edia, our first question for you is, the markets are down and inflation is high. What were the overarching conversations you had with your clients in 2022?
It was a tough year for everyone. Emotionally, it was very, very tough for most people. Now, if you think about what happened in 2022, the daily volatility, the intraday volatility, when I say volatility, what do I mean? Anything more than 1% move up or down for a certain stock every day. It was a crazy ride. We haven't had this type of volatility since 2008. And largely it was also due to the election year. The uncertainty in the marketplace is what drove a lot of this fear. Inflation numbers, the information that we have in the marketplace, people reading and listening to the news, we're emotional. Oftentimes I received phone calls from people just saying, I don't know if I can handle this. I want to pull out of the markets. I want to sell. And oftentimes I would talk to them about compound interest, staying invested in the market while the markets are volatile is very, very tough for a lot of people. You need to remember that we live in the era where a whole generation of individuals have not or do not even remember the great financial crisis. This is the first time that they look at their 401ks and see red. This is the first time when they're like, okay, I've been putting aside my money and now I see it losing. I could be spending it on the goods that are, from the inflation perspective, they are going to be more expensive next year. So why would I put it in the stock market rather than buying something that may be more expensive next year? So a lot of my conversations were personal. And we usually say the personal finance is 80% personal, 20% finance. And a lot of times it's behavioral finance that we are dealing with the individuals. taking a little bit of a step back, I work with people that are in their early 20s and people that are in their later 70s. And these conversations also varied. So, of course, some of the individuals that are in their 70s, I wasn't talking to them about, investing in equity markets that were volatile. That was not appropriate for them. We were talking about how do we reduce risk for you? How do we, instead of investing in tech companies like the slide you showed, Marshall, most of the companies on their slide were tech companies. And that has been the driving force for a lot of S&P 500 index returns. And of course, for people who are closer to retirement or who need to preserve their capital, we were talking about, all right, let's get excited about bonds, treasury bonds. This is the only time in my career that I can say that treasury bonds are guaranteed by the Treasury government. That's the only time that I can say that returns are guaranteed by the federal government. So now the treasuries, now the bonds are paying 4.5%. So for a lot of retirees, that was the conversation that I had with them. Also, in addition to the age demographic differences, there is a difference between individuals that we have worked with in the past for years and years and years. And there are individuals that we have worked with for a shorter period of time. So I am still in the process of educating people what they should be expecting from their portfolios. What does an aggressive growth portfolio look like? What does it should look like? And yes, if you see the losses, that's what you should see in a portfolio. It doesn't mean that you need to sell out necessarily. If we want to adjust it, we will. But again, it was a lot of education. I'm so passionate about, and I know Marshall, you are as well, and Troy, you are as well. We are all passionate about financial literacy and spreading it with people around us, just because it's not something that people can learn at school or high school. And it's something where I feel very passionate about educating my clients and saying, okay, this is what you should be expecting from your portfolio and investments. And also, individuals that have been with us in the past, they are weathered. They already know what to expect, and they know that they need to calm down, take a deep breath. They already have the cash positions in their personal portfolio that can hold them over a certain period of time. And we usually say, if you want to save for an emergency fund, you usually should look at 3 to 6 months worth of expenses or income, depending how you look at it, in your cash, and then start bucketing what you're saving for. Are you saving for a 2-year period of time? Then you're investing this way. Are you saving it for longer? Then you're investing differently. But that's kind of a long story of what our conversations look like. In general, it was a lot of personal discussions with individuals.
Yeah, and to me, it also seems like a lot of the heart of your conversations right now were talking about what is literally happening in the economy, but really what you were getting at is on a personal level, how do we as individuals really allow our minds to not get in the way of our future gains. We, as human beings, I think sometimes fall into fallacies in terms of our thoughts, and we get scared and we maybe make decisions that are not the correct long-term decisions because in the moment we're feeling frightened by what's happening around us.
Exactly. And you mentioned a few quotes, and one of the quotes that always sticks with me is Einstein. And what is the 8th wonder of the world? That's compound interest. And I believe wholeheartedly, especially now that when we look at the markets going forward into 2023, my background is in investment consulting and investments, like you mentioned before. And my job is to meet with investment managers, people who do this on a daily basis. They pick stocks. And I'll tell you how many meetings I have with investment managers. If you talk to a fixed income guy or lady who only invests in bonds and fixed income markets, they will tell you the world is falling apart because that's how their mindset is. They will always tell you the world is falling apart. Everything is going to be horrible. If you talk to the equity guys, the guys that invest in stocks and ladies, they will tell you the world is rosy. Everything is going to be fine. So you start listening to the news, you start listening to the people, you just start getting so confused, even as a professional myself. I need to take a step back and say, well, what do I know? What has the history actually showed us? And we know that the Treasury yields right now are inverted. What does it mean? It means that the long-term Treasury yields are lower than the short-term Treasury yields. That doesn't make sense to a rational human being, because you're literally getting less money for lending money for a longer period of time, which is more risky if you think about it.
Yeah,
so
totally.
So when it inverts, historically speaking, if we look back all the way up to 1959, before every single recession, we have had inverted yield curves. However, if you think about this even further, there is no specific time period for which these inverted yield curve has held. It could be 6 months and it could be all the way up to 20 months. So we don't know for how long. Currently, we've been in this environment when we look at the 10-year versus 3 months, about a month. So we know the recession is coming, but we don't know when, and we don't know how severe it's going to be. If we look at the numbers even more so, we can see that the recession doesn't necessarily translate into a negative equity market environment returns. 4 out of 8 periods or recessions, the equity market returns have been positive. So it's 50-50. It's going back to what I was saying. Nobody really knows what's going to happen. So nobody really knows if the equity markets are going to be positive or a negative. Are we going to have second neck, the way people saying, or second drop? It could be. We don't know, and we don't know when. What we do know is the treasuries right now are paying 4.5%. What we do know that especially for people who want to lock up their money for 2 to 4 years or so, or who are thinking about a shorter period of time. So you think about people in their retirement who want to preserve their capital. Treasuries is probably the place to be to lock that in, probably. But then for the younger people, like myself and you, and we have 20 years to go. The rule of 72 states that we should double our money, every 7 to 10 years, if you follow that ideology. So if we think about long term, we need to be brave. I'm not saying, oh yeah, go ahead and invest it all today. I'm saying, think about it and how you're investing it. And in this case, I would say dollar cost averaging is probably a good strategy to take. What does that mean? You just take every month and just invest a little bit every month. Just invest a little bit every month. I have seen my clients who have been taking that approach. They have done fairly well because they're not trying to time the market. I know it's exciting to time the market, and I know it's exciting to play around with your stocks, and do it if you want to. That's fine. Just, don't go crazy about it. I think being disciplined and setting aside money consistently, it should work for you long term.
Sweet. All right. I think that was a ton of information. We covered a lot of stuff, from the wonders of compounding interest, the yield curve inversion being a reliably accurate predictor for coming recessions, the idea of behavioral psychology, that we get in the way of our own money strategy at times, that recessions don't necessarily translate to a negative equity market, and dollar cost averaging being a great strategy for younger folks right now. Sweet. I want to take a brief step back just to look at a bit of the broader scale economy, because I want to use that to transition over into the real estate market and have Troy tell us a little bit more about what's happening over there. To make that transition, I think I will just bring up this idea that we just left off with the fact that, every indicator out there is showing that we are going into a recession. One of the things that happens that I think is one of the most critical components of a recession, of economics in general, is that we do need to tease apart indicators that are lagging versus indicators that tend to show up before events happen. So we just identified the fact that the yield curve inversion is a reliable predictor of an indicator, but we don't necessarily know how long after we get a yield curve inversion before we enter what we define as being a true recession. So that lagging part of the equation, I think, often can come up in some of these conversations. Now, transitioning that over into real estate, I first want to say that the Fed, they are the topic of a lot of the conversations in the economy in general. And there's a reason for that. It's because they are tasked with basically two big tasks, but essentially they're trying to maintain stable employment, which they're maybe going to put secondary on their list to maintaining price stability right now, because we are in a period where we have seen inflation numbers that are high. Now, transitioning this over into the real estate market, the reason that I was talking about all of this is because real estate tends to be one of those indicators that is not lagging. It tends to be a little bit more on the front end of recessions. And the reason that there's a lot that we could go into in terms of the housing market, but the reason for that is because oftentimes people think that mortgage rates are tied to the Fed funds rate, and that is not accurate. They instead, really, mortgage rates are driven by a number of things, but really they're driven by economic factors. And one of the big economic factors that drives mortgage rates is inflation. If I am selling a mortgage, if I am making money on the long term off of a mortgage by waiting for 30 years to collect interest payments, well, if inflation is at 2% and I charge, I don't know, let's call it 4% for my interest rate right now, and then tomorrow inflation is at 8%, well, then I'm not making money on the product that I just offered. And so obviously mortgage rates go up when inflation goes up. The flip side of that is that mortgage rates also begin to come down as inflation comes down. And we are at a spot right now where we are seeing inflation numbers come down reliably. We just got the new data on CPI on Tuesday this week. We are seeing that, we're down to 7.1 from 7.7%. So it was the second month in a row of great data on that front. However, the Fed just had their meeting yesterday. They did indeed hike the Fed funds rate again. We knew that was coming, but more importantly, their comments are what we're paying attention to. And what their comments state, honestly, it's a delicate balance, right? Because on the one hand, we have seen a stock market that has been frothy. The market is forward-looking and it tries to anticipate what's going to happen in the future. And so sometimes the market, even if they get bad news, if the market thinks, oh, but that's just temporary, it's going to go up in the future, it's forward-looking. So the market is not always reflective of where we're at right now. But with that said, the Fed and Jerome Powell specifically are trying to keep that frothy stock market from being too frothy, right? They don't want, so in some respects, their comments were, hey, we are going to continue to keep the Fed funds rate elevated for an extended period of time until we see inflation down at 2%, and it has been that way for a while. The concerns, of course, are that they're going to hold us there for too long and drive us into a recession. On the flip side, because mortgage rates start to come down before the Fed funds rate is going to come down, we have a totally different spot that we're in the real estate market. So that's what I want to hear about right now and jump into what Troy is seeing in the real estate market. So Troy, what are we seeing in the real estate market as we head into winter? And what are your predictions for 2023, as well as some of the key indicators that we want to be looking out for?
Awesome. Thanks, Marshall and Eddie. Really good stuff. And I think it's key to look at those indicators that aren't lagging. And so how we do that in real estate is we look at pending. Pending is a good way to the pending transactions. We can monitor that. We can monitor showing activity. What's the activity week by week? I just hopped off a call half an hour ago, a market update class, and it was just sharing some of the same info. So, I think what we're dealing with is we're coming down from a big high of the COVID era. And a lot of it was psychology. You have a lot of people that want a house. I need a house. I'm locked into my house. I can't leave. I'm shut down during COVID. So I'm entitled. I need to have a bigger space. And so that, we all know that it causes big frenzy of buying. And so there's just buyers that were just, knocking on every door trying to get in. And so there was that need to compete and to have something that other people had. And so obviously right now we're on the flip side of that, and we're coming down from that high. And so we're adjusting to that overinflated market and low interest rates, as we all know. So what we're seeing coming into the market is, I'll share my screen here. All right, so what we're seeing is just cooling from that, and you can kind of see that. 1 second. All right, so we've got 1 month of inventory versus an average of 3.5 of the last.
Troy, I only see that you have started screen sharing right now. Are you in the same boat, Eddie?
You guys there?
Yeah,
Yes.
Weird, yeah, it kicked me out for a second. Let me try again.
cool. Oh, Zoom.
Yeah, the loves of Zoom. All right, can you see that?
We can see
No.
you starting to share screen, but we don't see the
Oh, there we
actual
go.
screen. There you go. Yay.
Cool. Yeah, so some of this info is just hot off the press. I just got this from a market update class. So we have 1 month of inventory. And so some will say a balanced market is 6 months of inventory. So for every buyer that's out there, you have 6 homes to choose from. So what this says is for every buyer, you have 1.8 homes to choose from. This is the Denver market. So we were at 2.1 months of inventory last week. And what we're doing, we're falling off of Thanksgiving weekend, and Thanksgiving weekend was a little skewed. So now we're down from 2.8 or 2.1 down to 1.8 months of inventory. Again, the average for the last 15 years in Denver Metro was 3.5. So that is more of where 6 would be a balanced market. We're in a buyer's market now. 3.5 is what we've seen the last little bit. The odds of selling is, what percent of chance if I'm going to put my house on the market today, could I sell it? Could I get under contract in 3 weeks? That number is 45%. So it's about 50%. That is actually up 2%. So we're seeing the odds of selling actually increasing. A lot of people think about, hey, the market's crashing. We're going to have a flood of inventory or short sales. There were 2 properties last week that of the 3,000 that sold that were distressed. Only 2. 1.6 showings per property per week is what we've seen. And it takes about 13 showings to get an offer. That was actually 15 last week. So we're down there as well. And so what we're seeing here is that it's starting to shrink back as inventory is shrinking. And what's happening is we have withdrawn and expired. So people are saying, hey, I'm going into the winter months, into the holidays. I'm just going to take my home off the market and then relist in spring and see what happens. So that showing number came down 34 median days on market, average of 60 in the last 15 years. And then 45% of homes made a price reduction at about 7.2% of the original asking price. And then about 1/5 of all transactions were paid in cash. Come down here, you'll see inventory. You'll be able to see this number drop as well. So the previous week through December 5th, you had 1,233 price reductions versus last week, 953. New listings were about the same, 659, 667, but the pending the week before was 659, and there's more pendings, over 140 increase in pendings from last week. So starting to see a jump of activity as buyers are looking out there of what's still on the market because the inventory is shrinking. And so I just might as well take advantage of the market right now. And this says currently 10,500 active listings versus last week 11. So you're seeing that dropped about 600. The other thing that's really important to note that I think is a very critical factor that people avoid to look at or consider is demographics. The median age of the largest population is millennials, and it's 31 is the median age right now. The median age for the home buyer is 34. So in theory, in 3 years, next couple of years, this right here, the circle is the biggest opportunity for home buyers. And so I think we have a lot of those buyers on the fence that are wanting to time the market. Like we talked about, they say, hey, we're going to see a crash. And honestly, people are trying to be the hero and trying to be the ones that time the market and get rich. But in all reality, I think the next opportunity is right here. Once that large bracket and the buyers get back into the game at the same time, it's going to be too late. Kind of my quote that I have is, you aren't going to catch the biggest fish fishing in the same boat as everyone else. And so the opportunity comes when you take action when others won't. So it's going to be those that are brave to go out to say, hey, I've got opportunity here. I can do negotiations on the property. I can get money from the seller to do a concession. I can buy my rate down to 5%-ish or lower, possibly refi later. So really, that's what I'm seeing is there's a lot of opportunity right now for those that are willing to take it. And Marshall, I think that pretty much sums up kind of what what I see. Do you want to?
That's fantastic. I mean, just going off of the last thing that you said there, that's kind of the broad scale theme that I find interesting. And I mean, obviously, I have some notes down here in terms of just the pending home sales, the number of distressed properties, all of that. But the bigger picture that I see is what you just said, and it makes me think of the Warren Buffett quote to be greedy when others are fearful, and be fearful when others are greedy. So yeah, absolutely. It's a challenging thing. Again, returning to the idea of mindset. But when we dig into some of the data and the numbers a little bit more, and we try to make some meaning of it, it does give us that perspective a little bit further of like, I know it's challenging to be greedy when others are fearful, because you're looking around and everybody around you is saying, but that is where there are opportunities as well. So taking the time to do what we're doing right now, look into some of the numbers, is a fantastic way to start down that path. Perfect. Well, on my end of things, I think that the big thing that I wanted to talk about here, and I have some statistics as well that I can pull up, but the big thing that I will say is really housing. From my side of things, from the mortgage side of things, the big thing that I want to talk about today is I'm not going to pull up necessarily the chart of what interest rates have done over the past year. It has been a wild ride. Inflation has gone up. And as we talked about earlier, mortgage rates follow that. So mortgage rates did go up to about 7.5% this year. We are down from that at the moment. When I looked at my chart of average locked rates from yesterday, I believe that a conventional 30-year was somewhere around the 6.25 range. Now, when we look at those numbers, there is a little bit of a bias built in there because we don't know if folks are buying down their interest rate and how much it costs to buy down the interest rate. We're just looking at the average locked rate, but still, it does give us a good indicator because our average locked rate was 7.5% maybe even just a month ago or so. So the last 2 months of really fantastic inflation reports with inflation coming down has been great for the interest rate market. Now, with that said, where we are at is it is still a very slow market. And the reason for that is really revolving around housing being, in some respects, a fantastic investment. And in some respects, housing is not an investment. And the reason that housing is not an investment is because I live in my house. So I don't think of my house as being like a stock that is almost like a baseball card that I'm trying to trade to get the most value out of. I'm not going to sell my house like I might a stock because I'm like, I think, there's a possibility that the value goes down. No, a mortgage is somebody's cost for shelter to their reasonable ability to afford that debt. So if I can still afford the debt on my mortgage, then as a homeowner right now, I might have had another kid, or I might have gotten another dog. And I'm like, it would be really great to have a bigger house right now. But my mortgage is 3%. And I've heard that interest rates are high right now. They're at like 7.5%. And I'm not informed enough to recognize that, I don't think anybody has been, well, at least I haven't locked anybody in the past 2 months without them getting a seller paid buy down. But these homeowners don't necessarily know that, right? They're thinking, well, mortgage rates are 7.5%. And they don't know that sellers are buying down buyers' interest rates. And so if I'm in that situation as a homeowner, I'm kind of like, I think I am okay with this smaller house for a little bit longer because I want to keep this 3% interest rate and I don't want to have to move when, interest rates are 7.5%. Now, that means that, in terms of what's happening as an investment side of things, gotta mute. Oh, there we go. Steve, you gotta mute yourself if you can, or just turn that thing off. Or I muted me. Steve, turn your phone off.
Sorry.
You're good. I was just getting distracted by it because you know how I can be in that respect. Okay, so anyway, we were saying essentially that houses are an investment. I mean, when you look at the numbers on a buy versus rent, somebody who is renting compared to buying a home, it is the place where people begin their long-term wealth building journey. But with that said, again, we do not tend to try to sell a house because we think, oh no, the price of the home might begin to drop. Now, when this part of the conversation comes up, we also oftentimes get the question, well, what happened in the 2008 recession? And so that's where I do want to actually bring in a little bit of some numbers here just to show you a little bit of what happened during that recession. And so first of all, I will pull this. This is a free website that you can search this on government websites and come up with this chart. I just screenshotted it from there. But basically, this is the median home price going back to 1961. The gray bars that you can see on this chart indicate recessionary periods. What you'll notice is that typically the median home price during a recession either stays flat or sometimes it even continues to slightly rise. There's been one big exception to this, and that was the 2008 recession. And the reason for that is because the housing bubble caused the 2008 recession, not the other way around. The recession didn't cause the housing bubble caused the recession. Now, there were a lot of reasons for that. Troy already hit on some of those reasons. Demographics was one of them. Another reason was loans were not done well at that time. There were all sorts of crazy things happening. People had no documents, applied for a loan with a 520 credit score. Yeah, sure, you got it. And so that was a problem to begin with. And also negative equity was much higher. Negative equity was about 25% during that time frame, whereas right now the numbers just came out on the CoreLogic third quarter home equity report. And right now, the number of homes that are underwater is at 1.9%. That's down from 2.2% last year. And again, compared to that recessionary period during 2008, where those numbers were at about 25%. Demographics is the other thing. Troy already covered this, so I'm not going to go too deep into it. The reason I have a 33-year-old on there is because that's the average age of a first-time home buyer, 33, 34 years old. And what we see is that if we zoom forward from 33 years, basically 2008, well, if you zoom back to 33 years before 2008, again, reason 33 years is because that's the average age of a first-time home buyer. That was in this time period right here. Notice that there is a big decline in the population. There's a reason for that. There were lots of things happening at that time. One of the things that did cause this drop in births underlying each generation was the legalization of abortion at that time, amongst many other things. But what we look at if we zoom 33 years forward is you see that number, the births underlying each generation, well, that translates to household growth when it's 33 years into the future, right? Those people have already been born. Now they are going off and they are forming new households. And the household growth is shown in the blue or purple, whatever you want to call those bars here. Notice that same drop in the births underlying each generation is present beginning in 2004 and going into the recession. And yet home builders were still building. And that's the orange bars, that's annual completions, number of new homes built. Notice that they were still building even though there was this demographic drop. So we ended up in this situation where we had bad loans being done and we had a demographic drop where home builders kept building. We ended up with a huge oversupply of homes. After 2008, home builders basically got scared and stopped building. And right now, unfortunately, we are just in a position where we have less homes than there are people who would like to buy one. Like Troy said, the millennial population is the biggest population that is aging into their prime home buying years. And yet right now, they don't want to buy homes because they feel like interest rates are too high. Yet on the flip side of things, this is the part that I really want to highlight. So I'm just going to stop here and highlight this. On the flip side of things, we also have low inventory, like I just said. And so when interest rates come down, what do you think is going to happen to people who are bidding on homes? We're going to end up in the same situation that we were in March and April of this year, when people knew that interest rates are going to start going up. And they were bidding over ask on houses, making the home prices go up more than they should have. We saw 20% appreciation, 30% appreciation in some pockets. That is not sustainable. And obviously, interest rates have slowed that down. But once interest rates come back down, that is the sign for a lot of people to start jumping back into the housing market. So I unfortunately fear that looking forward into the future, again, who knows what's going to happen, but I unfortunately fear that we are going to end up in a situation where either whether you own a house or not will become another thing that continues to make our inequity gap in the United States in terms of wealth continue to grow bigger than it has already grown. So that's a fear for me, but at the same time, we are talking about some of the things that we can do in our own personal finances right now, just to be forward looking in that respect. A few last things that I will note are simply home prices, because that always comes up during the conversation. The thing that I really want to say about that is the media loves to be negative on housing. And since the 2008 crash, really, they have kind of just pooped on housing as a whole. And yet home values are up 115% from 2012, and they're up 39% over the last 2 years. Since interest rates have gone up to 7.5%, the Case-Shiller index, which measures home values, well, it's down 1.5% since the peak. So keep in mind, again, people were bidding up home prices because they knew interest rates were about to go up, and interest rates then went up. So a lot of people expected that home prices would drop 20% or 30%, that we would have another bubble. And yet home prices are down 1.5%, even though interest rates went from high 2s to 7.5. That makes homes much more expensive for somebody who's taking out a mortgage, right? So why did home prices only drop 1.5%? It seems like they should have dropped more. Well, two reasons. We do expect there to be a little bit more softening on home prices because the data that we've seen right now is lagging. It hasn't fully incorporated in peak interest rates, but we're not going to see that massive 30% drop that people were calling for because of this fundamental factor of we don't have the number of houses that there are people who want to buy one. Again, part of the reason that we're seeing a slow market is not necessarily, it's more so the fact that people who already own houses and have a 3% interest rate are not moving as much as they might. So that means that the circulation of home sales has slowed down significantly. All of that said, that, if you are in a position right now where you are thinking about buying a home, Troy already mentioned this, but from my perspective, it is a fantastic long-term investment right now, even though it is not necessarily an investment. Again, homes are kind of an investment, and they're kind of also the place that you live. So same thing with everybody. If you have specific questions on that, get in touch with any of us. We love to dive into the numbers and really go deep on your specific situation. But I think that's kind of the broader overview of everything. Anybody have any last comments? And then also, if there are any questions, we'd love to field those.
Yeah, Marshall, I think that's really spot on. And I think, we've talked about this too, is rather than just saying interest rates are high, I'm going to wait for the new year. That's like a mantra that a lot of people are saying, but rather, what is my monthly payment that I want, that I can make? What's that number? And then how do I get there? Look at the house. Okay, that's this number of a house. I can make that work. I can't make that work. I need to get my interest rate down here. Need to get the number down. And that's where someone like you, being creative in your financing, to figure out where that sweet spot is. So could you just touch on 3-1 buy downs, 2-1 buy downs, permanent buy downs? Like, where's the best bang for the buck, and like, how does that work? A lot of people might not know what a 3-1 or a 2-1 is.
Yeah, absolutely. So the 3-2-1 buy down, the 2-1 buy down, and the 1-0 buy down, they are all a version of the same thing, which they are a temporary interest rate buy down. They can only be funded by the seller of the house or other interested parties. So technically, your real estate agent could send you the funding for that buy down out of their commission, but they're a fantastic option for folks who are wanting to get a little bit of relief on their mortgage payments for the first year, 2 years, or 3 years. The 2-1 is the most common one, so I'll just talk about that one. Basically, what happens there is that your interest rate is a full 2% lower for the first year that you have it. Then it adjusts to 1% lower than the locked rate for the second year. And then in the third year, it goes to the fully locked rate. Now, if you lock your rate at 7% today, which, like I said, we're looking at more like 6.25% right now, but let's just call it 7, just call it even numbers. A 2-1 buy down would mean that your first year of payments would be at a 5% rate, your second year at a 6% rate, third year and beyond at a 7% rate. Well, some people might say, well, then my payment's going to go up on year 3. And that is true, but 2 counterpoints. One is, if you're somebody who expects to continue to increase your income, well, then that gives you some time to adjust to that higher payment. However, the bigger thought on our end of things is that just economically, we foresee inflation continuing to come down. Therefore, mortgage rates will continue to come down. So we anticipate that the vast majority of people who are going under contract with these particular programs right now are going to refinance out of that loan before they ever reach that fully locked rate that they had locked, that 7% rate in my example. The one last thing that I'll say about this, and I was seeing if I could just go ahead and pull it up, but it's hard to do that type of stuff when you're also chatting so much. But I do have a calculator that I have created that basically analyzes for folks the difference between a temporary buy down and actually buying down your interest rate permanently. And then it actually also analyzes what it would look like for folks if they were to, instead of using seller contributions to, let me see here. I'm not going to pull this up. Never mind. I was going to show you all. Actually, maybe I can still. But instead of using those seller contributions for either of those interest rate buy downs, it also shows them what it would look like if the seller instead gave you a price break. And it's kind of cool to run the numbers on that type of stuff just to see how long it would take before the particular scenario would work better. So again, like I said, I'm not going to show you that full thing, but this is basically how the calculator works. I enter in the property information, of course, the loan information, and then with the seller contribution, we say, let's say that they're giving us $10,000. We say, well, what would the difference be between if they, instead of having a $500,000 house, they adjusted the price $10,000 lower to $490,000? And we compare that to, well, what if we use that $10,000 of seller credit that they're willing to give us for a permanent buy down or a temporary buy down? And basically what this calculator does is it shows you all of the numbers. And then it also shows you this nice graphic where basically at this particular time where you can see the break between these two, that's the payoff period at which it would make more sense to go with the permanent buy down instead of the temporary buy down. So anyway, that's the type of stuff that gets very personal based on somebody's exact scenario, but that's the type of stuff that I like to use just to really advise clients towards the best long-term savings, rather than just being like, nah, let's just do this because it seems like maybe it'll save some money.
Marshall, I was sitting here on pins and needles thinking about my conversations with some of the clients, and I am not an expert like you are, but I oftentimes tell my clients, you need to think about how much you're going to be paying for your house. And I usually suggest that it should not exceed 25 to 30% of their intake, their cash flow. Always think about the cash flow. And also I remind people saying there are different ways of not just doing 20% down. It's just something that has always been like brainwashed in our minds ever since I've been in the United States. It's always 20% down, but it's not necessarily the case. And as you're saying right now, there are different options. So even if you're considering buying a house, the thing you can do is talk to a mortgage loan originator or someone like yourself who know what they're doing. And that way you can make your decision if this is the right time for you to buy a house. Don't make your decision just because of the limited knowledge that you may have.
Yeah, exactly. Yeah. And the thing that you just said is actually a conversation point that comes up often for me. That is a fantastic piece of general financial advice. For me, it's not 25%. Generally, I try to suggest that your housing expense is about a third. So a close number, but a couple of percentage points off, but about a third of your monthly income. However, that varies for different people. So I have multiple people on this call that I've done some mortgages for that are in totally different boats in terms of where you're at in your life. If you're at a point in your life where you anticipate that your income is going to continue to increase from here on out, meaning, let's say that you're in your 20s or 30s, then maybe going a little bit higher on that debt to income ratio is okay. Maybe you can push it beyond 33% up to 45% or something like that. Whereas if you're more advanced in your years, then I wouldn't recommend that if you're not planning on having income increases. And instead, I would say, no, let's make sure that this housing plan fits within your broader scale budget by keeping it at around that third mark.
Absolutely. And that's why the financial plan is so very important. Then working together with different professionals, you're welcome to bring in your tax accountant, your real estate agent, your mortgage originator, and your financial advisor. Bring them all in the same room on the Zoom call and knock things out and ask all the questions that you need. Just be informed.
No, that's awesome, Eddie. I think, the information is the piece. I think that's kind of why we got all together, is the miscommunication and the media of what they're telling you. But if you look at some people, like I follow some podcasts, and there's a lot of investors that are picking up properties right now, and they're factoring in that number for when they're going to do their flip, or maybe they're going to do a long-term hold right now and rent. So there's definitely opportunity out there for those that are willing just to look at it. And so I think that's what we wanted to say to you guys. I'll just talk to your experts and pencil it out. It's free. It costs a little bit of time, but look at it. Does it make sense? Great. If it doesn't, then it doesn't. But I think in many cases it will. And like you said, Marshall, it's dependent on if you do need to buy or what your situation is. And I think, again, the other key point too is the inventory. We don't foresee that coming, and it's shrinking right now. So we'll see what happens in the spring. But I think after the Super Bowl, and definitely the Broncos are not going to win or even be in the playoffs, or maybe not even win a game. But I guess they've won 3. But regardless, once people go through the holidays, tired of sitting around, tired of eating, they're going to go out and start shopping. And so there's going to be a frenzy come the spring. So watch out. That's my prediction.
All right. It's on record.
On record. There it is.
Perfect. Did anybody have any questions that they wanted to bring up?
Cool. Well, we can wrap up and send this out. And if anyone needs any of I guess we don't have an official slide deck. We had different slides, but if anyone wants to see the materials that we presented, happy to share that as well.
Yeah, I wanted to just collect those, and I figured I'd send them out to everybody just as a follow-up, as well as a little tiny bit more extra information if you are interested in finding out about Edia or Troy. Edia has a podcast that she was interviewed on about her experience of moving from Latvia to be in the United States as a badass financial advisor, and Troy has a whole host of resources. So we'll send that out, and you all can find out more about your panelists, and you can, of course, send us any questions that come up in the meantime between then.
Yeah, and then lastly, we haven't set the date, but we'll be doing this again in January, and then likely looking to do this quarterly. So stay tuned for more.
I look forward to it. Thank you for participating, everyone.
All right,
Thanks,
you all.
guys.
Make it a great one.
Thank you.